This past year has been distressing for economies in markets around the world. From limited supply mid-war, geopolitical tensions, and environmental disasters, to scramble supply chains post-COVID, to flood money supplies following unprecedented degrees of economic intervention, high inflation has ravaged many countries, and the US is no exception. Given the erratic market behavior that comes courtesy of economic crisis, traders and investors may be hunting for safer securities to keep their money in. For those who are looking for the most stable financial assets available, US Treasuries often make the top of the list. Let's explore when and how to buy Treasuries. So, what are Treasuries? Treasuries is an umbrella term that refers to many kinds of debt securities for sale via the US Department of Treasury. Available in short-term T-bills, 2 to 10-year T-notes, and 30-year T-bonds, they are a type of financial asset that enables investors to effectively lend money to the US federal government for a set duration of time and receive a fixed rate of interest in return. In our content, you may have noticed that we occasionally use our own proprietary software to research the markets. This market scanner is called the A1 Edge Finder, and it is a tool our team has spent a lot of time designing and updating. The scanner imports data on things like retail positions to see what retail traders are buying or selling. It also imports bank and hedge fund positioning so that we can get an inside look at what the big players are up to. Of course, we pay attention to fundamentals, so we program the tool to grab economic data in real time to help keep us up to date. If you'd like a copy of the tool yourself, we're doing a major subscriber discount when you use code A1YT at checkout. In the description below, you'll find a link to get access to the tool. By purchasing our software, you'll be supporting our research videos here, as well as getting access to an amazing tool. Again, use code A1YT down below. Now, back to the video. Another prominent kind of treasury are Treasury Inflation Protected Securities, or TIPS, which indexes your money to the rate of inflation in the US. So, why purchase them? Well, owning treasuries comes with a variety of benefits that can seldom be found elsewhere among financial assets. Perhaps the greatest perk is extremely low risk, since your purchase comes with a guaranteed return for those holding until maturation, quite different from most financial markets, where traders must fend for themselves in terms of risk management. Another factor that minimizes risk is the financial stability of the US federal government, for which bankruptcy is ostensibly impossible. Are there downsides? While there are unique perks for opting for treasuries over other securities, there are built-in disadvantages as well. For those planning on holding onto a treasury until it matters, perhaps the most noteworthy is the additional risk of inflation diminishing one's real rate of return, since inflation is a dodgy phenomenon that cannot be anticipated perfectly. Combined with frequently low yields on treasuries the past few decades, there is always a chance that inflation could completely negate the income's new purchasing power. Additionally, for those who may want to sell a treasury before its maturation date, there is a significant degree of interest rate risk, since the security likely won't have an identical market value to when it was purchased. When are yields the highest? If earning passive income is the goal, rather than simply protecting purchasing power via TIPS, timing matters a great deal for the sake of purchasing treasuries at an optimal price. Historically, higher treasury yields often correlate directly with a higher federal funds rate, which is intentional, not coincidental, with the 10-year T-note yielding over 10% annualized interest in the late 70s and early 80s. The more the Federal Reserve raises interest rates, the higher yields are likely to be. Considering how hawkish the Fed has recently become to quell high inflation, sustainable yields could be around the corner. If inflation remains a persistent threat, enough for the Fed to continue hiking interest rates according to their most recent projections, the federal funds rate might be raised to a range between 2.9% and 4.4% in 2023. If the Fed funds rate does surpass 4% for the first time in over a decade, this may well correspond with the 10-year Treasury doing the same, presenting lucrative buying opportunities for those interested in waiting out high inflation for a longer-term maturation period. It could even be the case that the Fed must hike rates even more severely, in which case Treasury yields could become far greater than currently expected. Currently, the Edge Finder market scanner rates the US 10-year and 30-year Treasuries as a 5 or a buy, respectively. Ways to buy. Anyone may purchase U.S. Treasuries from the U.S. Treasury Department via the Treasury Direct website. at reoccurring auctions you can track throughout the year. However, one may also buy or sell treasuries through a variety of banks, brokers, and exchange trade funds. Some key takeaways. In times of market turmoil amid economic uncertainty, it can be helpful to consider safe securities to invest in. Among these options, U.S. Treasuries historically reign supreme. There are several different kinds of treasuries which have different maturation lengths, including T-bills, T-notes, T-bonds, and TIPS, which are indexed to inflation. U.S. Treasuries are debt securities backed by the U.S. federal government. They enable buyers to lend money to the U.S. government in exchange for fixed interest payments. There are certain benefits to owning treasuries that are quite rare for financial assets. Chief among them is a near absence of risk, as fixed interest payments guarantee specific returns and the chances of the U.S. federal government going bankrupt are near zero. However, there are much downside to owning treasuries too. Perhaps the biggest risk for those holding on until maturation is that the severity of inflation will impact the real rate of return. For those who may want to sell a treasury bond before maturation, there is an interest rate risk. The treasury's new market value may have depreciated from the time it was purchased. Thus, to maximize income from treasuries, it is helpful to wait until treasury rates are optimal. Historically, the higher the U.S. federal funds rate is, the better treasury yields will be. Depending on how high the Federal Reserve sets the funds rate, it is possible that a 10-year treasury yield could cross well above an annualized rate of 4% for the first time in over a decade. This rate could potentially far outlast high inflation, bolstering returns. While all kinds of treasuries are available directly through the Treasury Direct website at recurring auctions, they are also available for purchasing through brokers, banks, and ETFs.